Okay. Good afternoon, everyone. Thanks for tuning in to our webinar today, which is titled How to Structure Your Business to Pay Less Tax. My name is Paul Habert. I'm with Hanser Financial, and we are a full-service financial planning, estate planning firm and investment advice. Today's topic is really geared towards the small business owner. In a moment, I'll introduce you to Aaron Grinhouse of Grinhouse Law, and he's going to take us through some of the ways to structure your businesses, indeed to pay less tax. And the beginning may be a recap for some of you who already have decided upon your structure, but Aaron's going to tell you a little bit about how to squeeze more juice out of the orange, if you will. At Hanser Financial, we have many ways of helping you also in this regard, to saving tax. And if you are set up like a corporation and using things like corporate class mutual funds and to be able to use your capital dividend account and take advantage of it, are all kinds of strategies that we can discuss. But today, wanted to add some value with one of the experts that we deal with, and his name is Aaron Grinhouse. We've introduced a couple of our clients to Aaron already and have had rave reviews. I want to also let you know that Aaron is running for, and I'm going to get this right, Toronto District School Board Trustee. It is our pleasure to have him. I'm going to turn it over to Aaron Grinhouse.
Thank you very much, Paul. Thank you for that very nice introduction. So we're going to talk today about how to structure your business to pay less tax. There's a PowerPoint to accompany this. You can follow along. Let's see if are we active? There we go. Okay. So the purpose of this presentation is really, a lot of the people who are viewing this have already been advised by their accountants, likely by some lawyers, and of course financial advisors, but this is more to give you a background and an understanding so that you know what the tools are basically that are available to you for estate planning and structuring for your small, mid-size, or family-owned business. And you can increase an understanding on how everything works so that you don't go in blindly. You have some background, you have some knowledge, and maybe even get some ideas about what you should be hearing about from your advisors if you're not hearing it. So the background of this, or the outline of this presentation, is going to be a little bit of basic background, different types of business vehicles. Many of you are incorporated already, so you know about that one, but there are other ways of doing it. Comparing those business vehicles, and of course, how you structure your business. Oh, skipped over. Basically, I just wanted to, the basic principles of the tax system. Number one, you're allowed to structure your affairs any way you want to minimize the amount of tax you want. Now, that's within the constraints of the avoidance rules, tax avoidance rules, but generally speaking, it's been well established. You can structure it any way you want, so don't be afraid to be creative and think outside the box. Just make sure you're advised properly. And of course, the three main units of taxation are the individuals, the corporations, and trusts, which is sort of an interesting unit that we're going to talk about in a minute. So we'll talk a little bit about some of the business vehicles. You've got a few options. Sole proprietorship. It's an individual. A partnership is like a sole proprietorship, but it's between a few individuals. Corporation is like its own person, and a trust is something special that we'll talk about. They're all used for different purposes, but they're all different tools that you can use when you're structuring, and they all have benefits, and they're all detrimental in their own ways. The focus on this presentation is going to be on Ontario. Business law is generally regulated provincially, so we're going to be focusing on Ontario. So just as I'm not going to spend too much time on sole proprietorships and partnerships, but I do want you to have a little bit of a background of what their purposes are and what they do. Sole proprietorship is very low maintenance. You have total control as the individual in the business. All the profits end up being yours at the end of the day, and you can deduct them from any business expenses from your personal income within reason, within the law. You can get insurance if you're afraid of the liability, but of course one of the cons is full personal liability, no protection from liability. The individual tax rates are they go right up to almost 50%, and you're heavily relying on yourself to run and maintain the business. So even though you can take employees, you can't use it to split income, to split capital gains. It's not very flexible with respect to growth. So something to think about when the situations when it might be good to use a sole proprietorship is if you're a small business. Your liability is very low. You have very low income. For example, a home business or a side business, and you don't actually incur a lot of liability or a huge tax liability. Those are times when you're just starting out. It might be a good time if you have no partners to use a sole proprietorship. And here's a comparative chart of the graduated tax system. I've compared Ontario, Quebec, and British Columbia with you add to the federal, which is all the way on the left side of the chart. So you can see that actually in Ontario we do have quite a favorable. I mean, BC has a pretty good tax system too, but Ontario is one of the lowest in North America, so we're in good shape. But that having been said, it's a graduated system, so it goes up and up and up the more you make, whereas, as we'll see in a minute, corporations are fixed, and that can be leveraged for your advantage. So the partnership is like a sole proprietorship, except it's with more than one person. It's not a separate legal entity like a corporation is, so it's still taxed at the individual level, but you can have partnerships between corporations, which is something that a lot of people do, particularly in joint ventures or in real estate partnerships and other types of commercial partnerships. So it doesn't really take away any liability, because the liability and the profits and the income filter down to the individual partners at some point. If the partners are corporations, then it's going to be dealt with at that level, but at some point you're going to have to take the money out anyway. And that's something I think that people here at Answer Financial specialize in. It's one of the things that I like working with them on. Nice. So the income and losses flow to the partners. You have to, and then limited partnerships, I wanted to just note, is where you have one general partner who's liable for everything, and the limited partners are only liable to the extent of their contribution. That's another good model. We can talk more about that if there are questions at the end, which I think we'll have time for as well. So the pros obviously are cost sharing, easy to set up, not expensive. Partnership agreement is very, very flexible. The Partnerships Act is very flexible. It's a very small piece of legislation, relatively speaking, especially relative to the corporate law. It allows you to create your own structure, whereas the cons are the liability that's incurred by the partners. It's hard to find good partners. That's a tough one, and there are all kinds of other commercial protection liability issues that arise. So one thing that I'll note now is a partnership agreement. A lot of people think a partnership agreement is synonymous with a shareholder agreement, and they are two different things. We'll talk a little bit about shareholder agreements, but generally speaking, partnership agreements are much more flexible. But shareholder agreements are far more rigid and address different types of liabilities in different circumstances. So, just as a summary of partnerships, some of the typical partnerships that you'll see are in investment ventures. Joint venture, just so you know, is a partnership with a limited purpose. That's basically, if you want to differentiate a partnership from a joint venture. Joint venture has a limited purpose. Partnership is ongoing. So the oil and gas industry, for example, when they're doing exploratory projects, will partner up with other companies just to see if there's something there. And if there is, then they'll continue under a different vehicle. So now let's talk a little bit about corporations, which is sort of the centerpiece of this presentation, and how they can be used to minimize your tax liability and to minimize your tax burden. The tax considerations, this slide I think is the most dense slide out of all of them. But a lot of this is going to be very familiar to you. What this says is, first of all, the first point is it's got a lower tax rate, period. Like, this, corporations are taxed at a lower rate. So if you can leverage that to minimize how much tax you're paying just by lowering the rate. That's number one. Number two was the Westminster principle, which is you can structure it any way you want to minimize your taxes as long as you do it within the law. The third point is to be aware of the attribution rules. So you can't always split income with minor children because it will be attributed back to you. Corporations are good for reorganizations and estate freezes. Some of you may have already undergone an estate freeze or a reorganization. In a nutshell, an estate freeze basically says that if you've had a company, the way it operates is if you have a company that's grown in value and you're holding common shares which grow as the value of those shares, you might have started the company, they were worth a penny each, and now they're worth much, much more because of the value of business. What you can do is you can trade those shares into the company in exchange for frozen fixed value shares so that your shares don't increase anymore in value, and then you put the ones that are increasing into some other entity, either a corporation or a family trust, where it can increase in value inside that entity and subsequently be split out, dividended, or distributed through a trust by dividend, or if you sell the business through amongst your beneficiaries to spread out your tax liability and minimize it. So we'll talk a little bit more about that later, but if you've heard of an estate freeze or a reorganization, that's the purpose. The purpose is to freeze the value that you own now and then put it into some other entity that will allow you to spread that income among lower people in a lower tax bracket than you. Just keep in mind that one of the main rules, one of the main maxims is two people paying $50,000 a year in tax pay less tax than one person paying $100,000 a year in tax. Okay, so two people, each of those people making $50,000 will be taxed at a lower rate than the one person paying $100,000. So the more you can split your income and minimize that tax liability, the better off you are. The other benefits at the bottom of the list, the last two, were doing shareholder loans and shareholder benefits, something to be aware of. There are also ways to leverage tax-free repayment. If you loan money to the company, you can take it back as a repayment of the loan, tax-free later. And the last thing that I put in there was a personal services business, which is something you want to avoid because it will eliminate any tax benefit from the rate of tax that you will find from a corporation. So if you're incorporated for the purpose of working for one person as an employee, you will not get the same benefits as a corporation that has a number of different employers as an independent contractor. You're going to be taxed like a person because you're really just an employee. And that's going to make your employer have to impose an obligation on them to collect and remit source deductions, CPP, EI, and employment and income tax from your paycheck. They will be assessed. You will be assessed. Everyone's going to be assessed. It's not fun. The one thing that I might note is, since I understand that Hanser has some clients who are medical doctors, is that if you're billing through OHIP and you're incorporated, remember that even if you're working at a hospital and you're still billing through OHIP, unless you have an employment agreement where they pay you a salary, if you are billing through OHIP, you're billing per patient. So even though you're only working at one hospital or one clinic, you're not a personal services business because your patients are all different customers. You don't have just one customer, the hospital, who's your employer. You have all the patients who are your employers. A personal services business might be a web designer, for example, who contracts his or her business out to a number of different design firms. Would be an independent contractor. But if they were only contracting with one who gave them all the business, they worked there 9 to 5, they gave them all the materials, they gave them all their clients, and they were reporting to them only, they're really an employee. And in being an employee and being an independent contractor is a question of fact. It's not a question of what your contract says. It's a question of whether you actually are. And if you are, you're going to be taxed accordingly. So it's something to keep in mind. It's a fine point, but it's important because it can remove any benefit, any tax benefit from being incorporated, from incorporating your business if you only have one client. So some of the pros are it is a separate legal entity. Everybody knows you incorporate, it protects you from liability. It lives forever until it's dissolved, whether voluntarily or involuntarily. You can divide equity, you can shares in your corporation to other people, and you can have a minimal minority stake of shares rather than having an equal business partner if you want to retain control of your business. And that share capital is transferable. The shareholder agreement we referred to a little bit earlier, the shareholder agreement, and what it does is it outlines the rights and obligations of the different partners, what happens if one of them dies, what happens to their share in the business, are you going to inherit a new business partner you didn't bargain for. Insurance, key man insurance is an important thing to put in your shareholder agreement. There's also something else to consider is the lower tax rate, relatively low tax rate. I mean, a Canadian-controlled private corporation, CCPC in Ontario, is now, I think, at 15%, whereas the highest marginal rate for an individual, and that's up to $500,000, up to the first $500,000. That's the small business deduction. Whereas an individual will be taxed as high as 48 or between 48 and 49%. So you don't want to be in that tax bracket. And of course, the structuring opportunities are, amorphous, the number of options that you have. So it's a good vehicle to use if you're a little bit bigger than a sole proprietor. There are lots of ways we can use it, turn it, play with it, make it work for you. So the cons, though, of course, is it's heavily regulated, costs a lot of money to maintain, set up, legal fees, accounting fees. Our fees are very reasonable. So if you're looking at incorporating business, please give me a call first. We can certainly point you in the right direction on how much these things should cost, how much they'll cost to maintain. And there are document maintenance and recording information, the minute book has to be kept up to date. All these things, you have to do a separate tax return. And then, of course, a couple of the other things that people aren't really aware of, or they're not as aware as they should be, is the piercing the corporate veil. So what that means is, generally speaking, it will protect you from liability, but it won't always protect you from liability. There are certain situations where directors are going to be personally liable for tax obligations, source deductions that are taken, HST remittances. If a director or an officer is using the company money for their own purpose, that's a big no-no. They don't like that, and they will impute liability to you personally. And of course, without a shareholder agreement, all kinds of conflict can arise, even from minority shareholders who can commence what's called an oppression action against the majority shareholders. So here is a little summary of the corporate tax rate and comparing BC, Quebec, and Ontario. As you can see, Ontario is pretty good. We're happy with the rates, and they have been going down in the last few years, which is also a good thing for corporations. So trusts, I'm just going to talk a little bit about a trust. Trust is interesting. Trust is not a separate person in the law, but it's also not it's not a person. It's not really one of the people who's involved in a trust. So what is it? What is it? I think the best way to describe what a trust is to describe it as a relationship. So you have a sole proprietorship, partnership, which are both taxed at the individual level. You have a corporation, which is taxed at the corporate level. And then you have a trust, which is really defined by the relationship between a trustee who has legal ownership to certain property, whether it be cash or real estate or shares or whatever, what have you, and the beneficial ownership. So as an example, I lose a lot of pens. It's not my fault. Sometimes it is. Sometimes I just go to meetings and I leave my pen, or somebody asks to borrow a pen and I lose it, or I hand out a few pens and I forget to get them back. So if I were to buy a very expensive pen, I know that Paul is very responsible when it comes to pens.
True.
He never loses a pen. So what I would do is, if I bought a very expensive pen, what I would say is, okay, I'm going to create a little contract where I give this pen to Paul, but Paul is only allowed to use this pen for me. Okay? So the question is, if I make a contract like that, who owns the pen? He has legal title to the pen. but he's only allowed to use it for me. And that's what a trust is. That's where the relationship is created. You have now taken this one ownership, simple ownership. I go into the store and I buy myself a pen. Simple, right? I own the pen. But now I've divided that ownership in two. Into legal ownership, the person who actually has the title to it, who holds it, and beneficial ownership, the only person who's allowed to benefit from this pen. And that's me. So that's what a trust is set up for. And there are actually three people involved in the trust. There's the settler, the person who actually first bought the pen, who creates the trust. The settler will go up to the trustee and say, I'm giving you this pen, and you're only allowed to use it for the beneficiary's use. Okay, and sometimes some of these people are the same people, but you have to be careful about how that's structured because it might result in the trust not being valid. So that's what a trust is. Okay, that's a lot of confusion around what a trust is. That's what it is. It's a relationship. So how is this relationship used for tax planning? Well, it has allowed us to do a lot of different things with property that we couldn't do without a trust. So we can give it to somebody else and let them manage the property for the benefit of a number of other people who don't have the capacity or interest or ability to manage the investments, the cash, the property, the shares, whatever it is. So one of the examples I put in here, and there are many, is how do we deal with an estate freeze and income splitting with shares in a CCPC, a Canadian Controlled Private Corporation? What we would do is we would exchange the shares, the gross shares, for frozen shares. I take them back, so it's an equal exchange, and there's no tax consequence because you haven't gained anything. You put those gross shares in a family trust. Now you can dividend money from the corporation into the trust, and the trust can distribute that money amongst the beneficiaries. So I think of a trust as an octopus, where the assets are held in the head, and they're distributing down the tentacles to the other beneficiaries. And the name of the game really is to make sure there is no money left or income coming into the trust, because trusts are taxed, unlike corporations which are taxed at a very low rate. Trusts, inter vivos trusts, the ones that are made while you're alive, are always taxed at the highest marginal rate. So if there's any money left in there, it's taxed at the highest marginal rate, but any distributions are deductible to the trust. So the trust will have income. At that income, if it stays in the trust, will be taxed at 48% or 49%. But if you get it out of there before the year end, then it's deductible to the trust and taxable to the beneficiary. And ideally, these are beneficiaries who are making nominal income, who are not making the type of income that will subject them to a lot of tax liability. So that's one example. The other way is to split capital gains, splitting tax credits, things like that. You can use it in a number of ways, depending on your situation. But the thing to note is that it is taxed at the highest marginal rate, and other types of trusts aren't necessarily. So spousal trusts or testamentary trusts, ones you make in your will, they're not going to be taxed at the highest rate. Okay, am I still going here? I ran out of gas. There we go. Okay, so now we're talking about, we talked a little bit about how trusts, this was actually what I just noted, was that inter vivos trust, highest marginal rate. Testamentary trust, the one that you create in your will, is taxed at the graduated rate. So those are actually intended for if the income earner, the breadwinner, passes away in a one-income household, so that the person will benefit, the remaining spouse will benefit from the income on the investments and the income that the person who was the sole breadwinner without having to rely on, in theory, the state, the country for additional welfare income. So we added, or Canadians added, an incentive in the Income Tax Act that would allow people to benefit from a deceased person's estate without being subject to the highest marginal rate. So that's the theory behind that. So now let's compare. Here's a little chart that compares the four business vehicles, if you can call them that we talked about. So sole props taxed at the individual rate. Partnerships the same, but partnerships can be corporations, so they'll get that benefit. Corporations have a flat rate up to $500,000. It goes up a little bit after that, but it's still lower than the individual tax rate. And then the two things we just talked about at length about it, the difference between inter vivos trust, which is taxed at the highest marginal rate, and testamentary trusts, which are taxed at the graduated rate. Are we good? Okay. So now let's talk about the last thing I want to talk about was structuring. So now that you know about, we've talked about a little bit of the basic principles: who gets taxed, when they get taxed, what gets taxed, what the different vehicles are, and how they get taxed. So these are the tools that we can use to structure you. How do we use them? Well, it can happen in any number of ways. Often there is more than one way. There's more than one idea. But it always depends on your particular situation. And it's hard for me not to say that, because you can have two people who have a small business that's making the same income, that has the same number of family members, same number of shareholders, but one of them wants to retire in 5 years and sell it, and one of them wants the business to go on forever in their children's hands. And if just that, the present day circumstance of the corporation is not what you look at when you look at structuring. You have to look 5, 10, 20 years ahead, where you see it going. If you want to sell it, you have to structure it a different way. You want to be able to split that capital gains exemption. You want to be able to maximize your tax benefits from that. And if you want it to keep going, you want to make sure that control stays in the hands of the right people. So generally speaking, now that you know about the tools, I'll tell you about the 3 pillars of structuring, which are tax rate reduction, tax deferral, and taxable income reduction. I'll talk about each one of those, and we'll get some time for questions. So tax rate reduction is a very simple concept. You just go with the structure that offers the lowest tax rate. So before we even start anything else, we know that corporations are going to be taxed at 15%, and an individual is going to be taxed at 48%. We'd rather use an entity that provides a lower tax rate. Now, that having been said, if you want to take the money out of the corporation and put it into your personal hands, it's going to be taxed at the personal rate. But while it remains in the corporation, we can do all kinds of other things with it. So it's good to try and reduce the actual rate as a starting point if we can get it into an entity that has a lower rate. And I put the abbreviated CCPC, Canadian Controlled Private Corporation, because we get benefits for that. I was going to say not to be confused with CCCP, which is a far different concept. No, we're looking at a capitalist concept here. So it is a popular term. You might hear that, CCPC, or QSBC, a qualifying small business corporation, which is another test that provides more tax benefit for. I won't get too much into that right now, but we can take some questions. So that was tax rate reduction. And then there's taxable income reduction. So once you've determined where you're going to have it, and the income comes into the entity, whether it's the individual or the business, now you have to focus on how you're going to reduce your taxable income. What is taxable income? Well, taxable income is determined by performing the following calculation. You have your net, your gross income. So all your income from worldwide sources in Canada is taxed, okay, unless it's exempt somehow. But generally speaking, gross income, every dollar you've made, minus your deductions, will equal your taxable income. Okay? So gross income minus deductions, whatever you can deduct from it, equals your taxable income. Just very basically. I mean, there are other things you factor in. Basically, that's the basic. And then once you have your taxable income, you apply credits, any credits that you have. So credits are applied after, and deductions are before. Mm-hmm. And that's how you reduce. So you can use all kinds of strategies, and this is also something that they specialize in at Answer, is using the corporate saved money to reduce your taxable income before it becomes taxed, and using things like RRSPs will reduce your taxable income as an individual because your any contributions will be deductible to your income. There are also some exemptions, like the lifetime capital gains exemption on the sale of a business, or exemption on sale of personal residence, the capital gains exemption there if you sell your house. So there are some other ways of just reducing your taxable income, just to make it as little as possible. And then the final pillar is tax deferral. So if I can just go back to RSPs for a second, RSPs are good because it's good for younger people or people starting out or people who need money in a certain year because they will reduce their tax burden. But later in life, they'll have to pay tax on it. When they start to draw on their RSP, they'll have to pay tax on that amount because you were given a deduction at the beginning. So that's deferral. So using an RSP allows you to minimize your tax liability today, but you're really just deferring it to the future. But deferring it is good because in the future you're in a better position to pay that tax.
And possibly a lower tax bracket.
And potentially a lower tax bracket. That's right. If you're spreading it out over a longer period and you're getting your RIF payments over a longer period. So one thing that I put at the bottom there is a TFSA is sort of the opposite of an RRSP in that you put after-tax money in, so you don't, you're not getting a tax benefit by contributing on the front end, but any gains made on the TFSA in the future are not taxed. So the RRSP is sort of the front end and short-term gain, and the TFSA is more of a long-term plan where the gains are actually very good. Very good.
Yeah, and actually sometimes we find that the TFSA actually works well in the in-between period, which is a lot of people tend to retire around the age of 65, and between that age and when their RIF minimums kick in at the age of 71, or usually start of 72, there's that period that they need to fund. So we're seeing now that we can get a whole lot of money into the TFSA that can grow tax-free for a number of years, and then when they take it out and fund perhaps that in-between period between 65 and 71, 72, that might be just the place to take it from.
Right. So just going through this slide, which I think is the last one, what we'll be doing, what we'd like to do with deferral is you don't, generally speaking, you might tax on money you haven't made yet. So until an investment or something crystallizes into cash in your pocket, it's not taxable. So typically you can defer at that point. So estate freezes are for that purpose. What you're doing is you're exchanging your growth value shares for equal value shares. So you haven't really gained anything. You're just taking back shares of equal value. And that postpones the tax burden. And of course, using investments and insurance is something that these guys specialize in as well. So structuring is, as I mentioned, very unique to every individual case. I'm happy to meet with clients and discuss their individual situations with them, sometimes with Paul, just to see what we can do for them. Always you should speak with lawyer, accountant, financial advisor, make sure that they know their stuff, that they know the different tools in the toolbox. They're not just fitting you into one box, because frankly, that will not end very well. It could end in serious tax liability. It could end in audit. It could end in, which is assessed, like if you're assessed by the CRA, the Canada Revenue Agency, that's not a happy place to be. So make sure you get the right advice. There's no one size fits all. It's important to know all the tools in the toolbox. So thank you very much. Is it possible to edit this slide? I just wanted to put my email address in there. I don't know if people can see it.
Well, I have the next one. I put our
phone
terrific.
Numbers,
okay.
Actually. Yeah,
so
phone numbers there.
Directly.
The email address is just aaron@greenhouse.ca. Feel free to call me, though, anytime, or send me an email if you have any questions.
Thank you very much, Aaron. That was really informative, and I like the simplicity you use, and this pen that I understand that I can now use, but only use when I'm talking to you. I'll throw it out there. If there's anybody that had questions for us or for Aaron, you can just start typing in, perhaps, to let me know you have a question. I think I can maybe unmute your line. This presentation I'm going to make available on our website, hansardfinancial.ca. If
you are watching this in the replay, feel free to email me with any questions you have. Again, it's aaron@greenhouse.ca.
Excellent. I don't see any questions, so I'm going to thank everybody for attending, and
Thank you for allowing me to do this, Paul.
Of course, and we'll do some in the future. We wish you luck in your bid for being a trustee.
Yes.
Actually, it's in my ward, so you got one
great.
vote.
Okay.
So that's a good thing.
Eglinton Lawrence.
Eglinton Lawrence.
Yeah.
And we're going to continue to do these webinar sessions for Hansler Financial clients and anybody else that wants to join us, probably every other month. So thanks very much, everyone, and we'll see you soon. Take care.